If you just glance at the surface of the markets right now, everything feels almost weirdly calm.
Uncannily serene, yeah.
Right. The surface readings, they all suggest a pretty healthy risk appetite. You have U.S. large caps basically flat, Japan showing strong momentum, gold and crude are firm.
But we both know what's bubbling up just underneath that exterior.
Exactly. The argument about whether we are sitting in a massive stock bubble, one that's, fueled by the promise of AI, it is just getting louder and louder. And that tension, that's what our deep dive is all about today.
It's the central contradiction every investor has to try and square right now. I mean, all our sources are grappling with the same essential question. Are these extremely high valuations we're seeing genuinely supported by a real AI productivity boost and sustainable fundamentals?
Or is it just classic euphoria? Is it just market positioning and, enthusiasm doing all the heavy lifting? So that's our mission. We are going to cut through that noise. We'll unpack the core debate, look at macro data that seems to be pulling in, opposite directions, and then we're going to get grounded with some specific corporate examples. We're talking Snowflake, MongoDB, PayPal.
To see who's actually making money from this AI wave and who's just talking a good game.
Exactly. We want this deep dive to be your absolute shortcut to understanding where the real risk is right now.
And if you look at the snapshot as of December 1st, the market is reflecting that tension perfectly. We call these our breakfast openers. The S&P 500 closed down a tiny 0.81%.
Which isn't selling pressure. That's a market holding its breath.
It's perfect equilibrium. It's a standoff between that, bullish AI fervor and some very real macro caution. Everyone is just waiting on the Fed and the next batch of economic data.
And the NASDAQ, up just 0.13%. That kind of confirms it, right? The recent tech pause isn't a reversal.
Not at all.
The momentum, it hasn't broken. It's just taking a breather, waiting for the next catalyst.
Right. And even that small rise in crude, up about 0.34%, it supports energy names. But, and this is the key thing, it's contained. It's not spiking high enough to really mess with the broader inflation story. The market's holding its breath, but it's holding firm near all-time highs.
Okay, so let's unpack that central question then.
Yeah.
Are we in a bubble, or are we just paying the right price for a huge structural shift from AI? I mean, Valuations are high, nobody disputes that, but the momentum just keeps going. So what are the historical anchors telling us about the danger here?
Well, you have to start with the bearish case because it's grounded in, decades of hard data. Valuations are high by almost any historical measure you look at. And the key piece of evidence here is the Shiller price-to-earnings ratio.
For anyone who isn't familiar with it, could you just remind us why the Shiller PE is such a critical metric, versus the standard PE that gets reported every day?
Sure. So the standard PE is just based on earnings over the last 12 months. And that can be really distorted by one-off events or, just where we are in the business cycle. Robert Shiller realized that to get a true sense of whether the market is expensive, you need a longer-term anchor. So the Shiller PE, or the Tate PE as it's sometimes called, it smooths out earnings over 10 years and it adjusts them for inflation.
So you get a much cleaner, non-cyclical view.
Exactly. It takes the emotion and the immediate cycle out of the equation.
So what is it screaming at us right now?
It is back near the levels we saw right before the dot-com crash in 2000. Historically, the Shiller PE has only been higher at the absolute extremes of 1929 and 2000.
Wow.
And the implication is pretty clear. History suggests that when you start from valuations this high, you're looking at significantly lower than average real equity returns over the next decade. That is the anchor the bears are holding on to.
That is a stark picture. But here's the challenge, right? This is what the AI bulls always bring up. Isn't the bear case always wrong when there's a genuine paradigm shift? Why should we trust a 100-year-old metric in the age of generative AI where productivity gains might suddenly jump, 30 or 50%?
And that is precisely the core of the conflict. The bulls, they'll concede the historical data, but they argue that today is fundamentally different, and their defense is powerful. It really revolves around two main pillars.
Okay.
First, corporate profitability today is just much higher, and global financial systems are way more robust than they were in those historical periods.
And the second pillar is AI itself. They frame it not just as a new technology, but as this foundational utility that just changes everything.
Correct. The core driver is this belief that AI is going to raise productivity across the entire global economy. But the key nuance here, and this is so vital to understanding the current concentration, is that this productivity boost is expected to reinforce the position of the existing megacaps, not challenge them.
That idea of reinforcement is so important. Why does AI inherently create a deeper moat for that handful of tech giants at the top?
Well, it's because building and training these frontier models is just prohibitively expensive and resource intensive. It requires enormous amounts of capital expenditure.
Tens of billions.
We're talking tens of billions in server and chip costs. Only the largest companies can even play that game. It needs access to huge, specialized, proprietary data sets that competitors just can't replicate. And maybe most importantly, it requires that specialized, highly scarce global talent.
So the barriers to entry are just. They're way higher than anything we saw in the early internet boom.
Vastly higher. So the market isn't just betting on general economic growth. It's betting that it can capitalize this durable, high-margin earnings power that's going to be captured by just a handful of winners. And in that view, traditional anchors like the Schiller PE, they just fail to capture the scale of this structural advantage.
That is the bull thesis. What's so fascinating is that both camps, they actually agree that a massive shakeout is coming eventually.
Yeah, they both see creative destruction on the horizon.
We're already seeing all the classic signs of a boom, right? We have retail frenzy, meme stocks are back, and this extremely narrow market leadership focused on just those mega caps.
But the scale of those speculative pockets is still relatively small when you compare it to the overall size of the established tech sector that's actually, driving the indexes.
Right.
And the historical record tells us that valuations are excellent predictors of returns over a decade, which suggests lower returns from here. But they tell us very little about what happens in the next 12 months. Momentum could easily carry us higher.
So what does all this mean for the person trying to manage their portfolio? I mean, if we avoid the binary call, sell everything or dive headfirst into meme stocks, what's the robust strategy here?
This environment really rewards position sizing and time horizon discipline. The best strategy isn't about trying to call the top. It's about staying invested to participate in that underlying earnings power.
Right.
But at the same time, methodically reducing your concentration in the most expensive, most consensus-driven names. You have to reduce risk without totally eliminating your exposure to the upside.
That's a practical takeaway. Stay invested, but be ruthless with your risk sizing. Okay, moving on. Let's see how this high-level AI debate is actually translating to corporate guidance on the ground. We're seeing some pretty patchy signals from tech, especially as markets wait for the Fed.
The immediate macro context really complicates things because the market's trying to square two dominant signals. One is overwhelmingly positive for valuations. Lower inflation and lower rate expectations.
Right.
The probability of a quarter-point Fed cut next week is now sitting at roughly 89%. That supports higher multiples for growth stocks because, the cost of capital is theoretically falling.
But the labor market is giving off these mixed signals that are much harder to read, right?
Precisely. On one hand, you have weekly jobless claims falling to their lowest levels since 2022. That signals incredible resilience. Yet when you look at the Challenger job cut data or the ADP payrolls data, those still point to a broader cooling trend, especially in those white-collar corporate roles. So the market is digesting strength and cooling at the same time. That's why we're paused.
Yeah. Now let's dive into this really fascinating comparison between two AI infrastructure giants. This, I think, is a microcosm of the whole bubble debate. We've got MongoDB, which is charting a path focused on immediate cash flow,
right,
versus Snowflake, which seems to be maximizing long-term market share and product vision, even if it costs them in the short term. Let's start with MongoDB's profitable growth path.
MongoDB is a huge standout right now, and it's an excellent model for what the market is rewarding today. Their new CEO, CJ Desai, has been very clear about pursuing high growth and profitability together.
Which is pretty rare for these high-growth infrastructure names.
It's very rare. The common playbook is usually grow at all costs. But they are tightening financial discipline while positioning their database as a core platform for the AI era.
And the numbers back that up, specifically on margins and cash flow.
They absolutely do. Their recent results showed operating margin moved 230 basis points closer to full GAAP profitability, and crucially, they achieved positive free cash flow, or FCF. It was about $8.2 million when you adjust for stock-based compensation.
Okay, let's just clarify that metric for our listeners. Why is looking at FCF, adjusted for stock-based compensation, so important for a high-growth tech company?
Well, in tech, companies rely so heavily on stock options and RSUs to compensate talent, especially those elite AI engineers. And while that's a very real economic expense, it doesn't represent cash leaving the building in the same way payroll does.
Got it.
So when we adjust FCF for this non-cash expense, What we're measuring is the true operational health of the business engine before that heavy, expensive talent comp. And MongoDB hitting a positive number here proves that their underlying business is now generating real cash.
That combination high growth potential tied to AI, plus disciplined cash generation, that offers a ton of optionality if market conditions change or the bull run stalls.
Now let's look at the flip side, the cautionary path of Snowflake. They gave guidance that really showed the struggle to monetize all that growth, and the stock dropped pretty sharply.
Let's get into this paradox with Snowflake because it is fascinating. They highlighted extremely strong product commentary, right? Rapid uptake of their AI agent, a massive $200 million partnership with Anthropic to bring Claude models onto their platform.
Right, it sounds like they're winning the AI race.
It sounds like they're winning, yet the market punished them. So why the contradiction?
The punishment came because investors focused completely on the cautious financial guidance, which signaled slower revenue growth and pressure on operating margins. And the key insight here is that AI features, like integrating the Claude models, they drive engagement and buzz, absolutely. But that engagement doesn't immediately translate into high-margin revenue.
So they're spending a lot of money and resources to integrate these features, which gets customers really interested, but the revenue follows on a much more uneven and difficult schedule.
Exactly. Snowflake's update is a powerful reminder that monetizing AI at scale, it takes time. It requires a lot of upfront investment, and the revenue stream is just lumpy. It's not a straight line. Investors are demanding immediate proof that these huge AI investments translate directly into profits, not just future promises.
It really makes the divergence between MongoDB and Snowflake a perfect microcosm of our whole valuation debate. The market is basically saying, we believe in the AI future, but we are rewarding those who can prove they can grow profitably today.
It connects right back to what we said earlier. The market is rewarding companies that combine that growth with really stringent financial discipline right now.
So moving beyond the core tech infrastructure, let's look at broader market health and some of those external risk factors. Let's start with PayPal and the challenges of a maturing core business.
PayPal is going through a necessary and probably painful evolution. They flagged that growth in their core, their branded checkout volume, is expected to slow down pretty significantly in Q4, down to roughly 3% or maybe slightly less, and that's down from 5% in the third quarter. That's a noticeable deceleration.
And why the slowdown? What's driving the competitive pressure on their legacy business?
It's just intensifying competition at every stage of the online checkout. I mean, they're not just battling traditional rivals anymore. They're facing these deep existential threats from integrated alternatives like Apple Pay and Google Pay.
Right.
And on top of that, big e-commerce merchants are increasingly choosing to use their own specialized payment processors to control their checkout experience, which often means bypassing PayPal's branded button entirely.
So if the core is slowing, how did management keep their overall guidance unchanged?
Resilience through diversification. Management pointed to robust and healthy trends in their other segments. We're talking about Venmo, their consumer app, their buy now, pay later services, their debit cards, their back-end processing.
So the newer products are stepping up.
They're stepping up and successfully offsetting the slowdown in the legacy business. The thing for investors to watch is whether this diversification can happen without hurting overall profit margins. But for now, the revenue shift is holding steady.
That pivot from a single branded button to a whole portfolio of financial services, that is clearly key to their future.
Okay, finally, let's look at policy risk, specifically the impact on Delta Airlines from the government shutdown. It's a great example of how an external shock can hit earnings and fast.
And it was a very material shock, specifically because of how the shutdown played out in aviation. Delta quantified the damage. A $200 million reduction in fourth quarter profit. That's about 25 cents per share.
And this wasn't just general economic blues. It was specific operational bottlenecks.
Exactly. Because some federal safety and security people were furloughed, the FAA had to restrict flight volume and air traffic control capacity at 40 major, very congested U.S. airports. That operational constraint led to a very real 5 to 10% drop in bookings over the 10 days that the uncertainty lasted. So did customers just cancel their trips, or did they reschedule? Was that underlying demand actually destroyed?
And that's the critical distinction. CEO Ed Bastian confirmed that bookings returned to their prior trends immediately after the uncertainty cleared up.
So the demand was still there?
The demand is resilient. So for the airline sector, policy noise is a huge material earnings swing factor, but it's ultimately transitory. It's not fundamentally destructive.
That is a crucial piece of knowledge, separating the noise from a fundamental shift. So as we wrap up this deep dive, what are the forward watch points you're looking at that will guide us into 2026?
First, market breadth. We've established that leadership has been incredibly narrow. I need to see if gains are broadening out to small caps to international markets. If not, the concentration risk just keeps getting bigger.
What else?
Second, I'm watching rate-sensitive balance sheet actions. I want to look for dividend cuts or major refinancing decisions from highly leveraged issuers, especially in sectors like REITs. If they signal distress, it means management is really uncomfortable with current funding costs.
And on the sentiment front,
Continued strength in retail participation, flows into those thematic ETFs. That would signal that sentiment remains overwhelmingly optimistic despite all the talk of high valuations. And finally, always track capacity, fares, and corporate travel budgets into 2026. It's a key indicator of underlying corporate and consumer confidence.
fantastic. We have synthesized a huge amount of information today. We started with this contradiction of a calm market sitting on historic valuations. We've seen momentum is holding, driven by the structural promise of AI, but that uneven guidance from companies like Snowflake shows the path to monetization is lumpy and requires a lot of patience. And ultimately, in this high PE world, your investment strategy just demands strict discipline and a long time horizon.
And if we connect this all back to the bigger picture, the market is sending a very targeted signal right now. MongoDB is showing that the market will vigorously reward that rare combination of high growth and tight financial discipline. At the same time, Snowflake reminds us that deep AI adoption is expensive, and product success doesn't always guarantee high margin revenue right away. So this raises an important question for you to explore. In a world where valuations are stretched, how long can you tolerate that lumpy, nonlinear monetization path if profitability lags? Or will the market just increasingly penalize any name that doesn't look like MongoDB?
A perfect provocation to chew on as you manage your risk. Thanks for guiding us through these sources today.
Always a pleasure.
And thank you for joining us for the deep dive. We'll see you next time.